Hello and welcome to Simply Tax. You don't need me to tell you that the tax world is complex, and especially this year, a bit of a moving target. Now, there are some areas that are particularly challenging, like, say, international tax law, where, as you've heard me say on the podcast before, I am generally quick to phone a friend to make sure I don't miss something or get in over my head. Private foundations and not-for-profit organizations can be another one of those areas where you can be cruising along, make one misstep, and
game over.
Okay, well, maybe it's not that extreme, but it can certainly feel intimidating and like there are a few landmines that you can inadvertently step on. That said, charitable giving and private foundations are something I find a frequent topic of conversation these days with those I work with. So that's why I've called up my lifeline in the area, Bernadette Zita, to break down some of the landmines and share what she's seeing in the area. Bernadette is a senior tax manager in BKD's Chicago office with 20 plus years of working in the not-for-profit area, mostly with hospital associations, foundations, and other charitable entities. I think you'll agree that this breadth of experience gives Bernadette a great and unique perspective to plan proactively and spot issues down the road. But don't take my word for it.
A lot of the entities I work on seem to cross between each other. I'll see a foundation giving to a hospital and be able to understand how both of them work and how they work together. Seeing all the philanthropy is really the most rewarding part of my job, and being able to help, especially some of these smaller private foundations that need the help, that just don't have the sophistication of larger entities to make sure that they're filing correctly.
I know there's been some areas lately, and obviously philanthropic giving is one that's on the mind for many on an ongoing and regular basis, but maybe some new considerations or ways that people are giving and trends that you're seeing. And so maybe we'll start there on what some of those are.
Yeah, I would say one of the biggest trends is online giving. There's so many more opportunities and easier ways to give online. People don't have to leave their desk or go anywhere. They don't have to sign up for that 5K right now to be able to donate. So they're thinking different ways. Other ways is through more community activism and those type of things. Not so much your typical write your check to the Salvation Army at the end of the year. That's more of an older generation. The younger people want to do it more either through gifting online or volunteering, I see, not as much as the traditional giving.
And probably even in this current environment, I'd say that definitely, like you said, changes it. And in fact, actually, I know we were even talking about one of those byproducts that sometimes come out of having good intentions and wanting to do good and help, maybe not having the experience of dealing with the tax side of it, dealing with a situation where a nonprofit gives cash to a for-profit, maybe to help out an individual or those sorts of things. What's the situation there?
Actually, we've seen it with a couple clients where we've had nonprofits actually give to, say, a local restaurant, and that local restaurant is actually using that money that they're receiving to then go and feed the community. In that instance, it's actually something where they would be able to take advantage of that money and not pay tax on it. It's more of a gift situation, and they're fulfilling the nonprofit's mission to help the community at this time. Like you said, typically a nonprofit can't give to a for-profit unless it can really help further their exempt purpose. So a lot of the social service organizations we work with are reaching out in that way.
The things that don't necessarily strike you out of the gate until you dig a little bit deeper there. On that subject, though, of giving more, any other things that you would maybe mention along those lines? I know you, like you said, the trend towards online giving and looking at the next generation and so forth.
With online giving, the nonprofit really needs to look at where that money's coming from. The attorneys general are getting a little aware of that. And if you do solicit in multiple states, you may have a filing requirement in the different states. So you may want to focus on certain states instead of the whole country so that you can narrow your risk and your exposure to filing. Not all states require you to file, and every state is different. That's the same as any type of tax. Every state will have its own type of tax. And it is a little bit different because it's with the Attorney General, so it's not an income tax. It might just be an annual fee based on the amount of sales. It can range from $15 to thousands of dollars. It depends on the state. But that's something to think about when you are trying to find new revenue streams, is the consequences that go along with it and the amount of work that could be involved. Especially with online giving, if you're receiving money from several states, you don't want to have to track several states who's giving from where. That could be more burdensome and timely than whatever profit you might make.
That's a really good point and consideration, right? That I think probably sometimes does get overlooked. And oftentimes organizations are, like you said, set up to be very kind of bare bones, or maybe they're not that large and just looking to, again, fulfill the mission and kind of have some unintended consequences there. And is there really an easy button way to do that and figuring that out? Or what's your advice? Because it does sound like it's a kind of a mixed bag depending on which state it is. So maybe it depends sort of an answer.
It really does depend. That's why I would consider focusing if you are going to reach maybe the states that you're most active in. Maybe if you're an alumni association, you might want to focus on the state you're in, and then maybe a couple local surrounding states where your students might have come from or where they might have gone in after they graduated, so that if you are going to meet those filing requirements, at least you'd be limited.
Being able to, again, weigh the additional compliance and then maybe the additional fees and whatnot, or tax, if it may be the case, against that solicitation as well.
Exactly.
Well, I know you mentioned private foundations, and it's a topic I know that comes up in the conversations I have pretty regularly because I think there can be a pretty powerful vehicle and a good vehicle if it's a good fit for folks. But maybe before we get down that road too far, maybe we just back up and start with what is a private foundation and how do you know if it's a good match for somebody's goal and philanthropic strategy?
That's a great question. A private foundation is usually a charitable entity that a family or an individual or maybe a corporation sets up where they donate money. They usually donate in the early years, maybe not in the later years or unless they receive money from an estate or something. But usually it's funded early on. The individual or the corporation would get a large tax deduction in the year of giving the gift to the private foundation. And the most typical type of private foundations we see are just grant making foundations, in which basically they're just set up to be an entity for you to give out grants on a yearly basis to chosen charities. They can give out scholarships, that's not uncommon, and they can have some actual programs associated with them. They can have program related investments as well, which they can actually reach out to the community and give loans, maybe in an economic development zone type loan to help inspire growth in a community. So there's a lot of different things you can do with them, but the majority of the ones we work on are just your straight grant making foundations.
If you're somebody that's looking to set one up or looking to do some giving, there's some flexibility there that, and again, some of the opportunities that you mentioned, maybe compared to something like a donor advised fund. Any thoughts on one versus the other, or how you would know if one's maybe a better fit for you?
With a donor advised fund, those are also where you pretty much are hands off. You donate the money to the fund and you can give directive every year on how you want those funds to be distributed. So it's very hands off. If you just want to get that one time donation and move on, it's a great vehicle. And there's a lot of benefits to it. With the private foundation, though, you have a little bit more control. You also are setting up a legacy for your family. So if you want to make sure your children learn how to give and live on in perpetuity, it's a great vehicle for that as well. The disadvantage to the private foundation is that there's a lot more bookkeeping responsibilities, tax compliance issues, and things like that. Where with the donor advised fund, you wouldn't have those responsibilities.
Responsibilities, maybe a few additional costs, but with that, you get, again, some of the flexibility, and you also you get to have the name on the foundation, like you said,
Exactly.
from the legacy perspective. Yeah. So now I will say in my experience, and I don't know if landmines is the right word here, but there's some things to watch out for and be aware of when you're dealing with the private foundation world, because there's some guardrails, I guess we'll say, to making sure that they're being used appropriately. We'll just put it that way. When it comes to private foundations, what are some things that you would say to watch out for, and maybe what are some tips in making sure they're being run properly?
Probably the most dangerous excise tax. And just a step back, private foundations are subject to 5 different types of excise tax. The most common that we run into is self dealing. And it's usually when a founder of the foundation makes a transaction and without even knowing it could cause an issue. For instance, if they wanted to loan money to the foundation or they wanted to pay compensation to themselves, there's rules that you need to follow to make sure that, for instance, with compensation, it's reasonable and that you make sure you document your time. And it's all good. It's usually never nefarious actions on part of the founder. It's usually they slip up. They just don't know the rules, don't know that they should have even asked. So we're here to help them maneuver through those. Like I said, loans could be an issue, or any transaction reimbursing yourself back and forth for expenses that you paid on behalf of the foundation. That is probably the most common. Another area is making sure that the foundation distributes out enough cash every year. Private foundations required to distribute 5% of their fair market value of their assets on a yearly basis. And sometimes they just had good intentions to write the check and they forgot to send it out or something like that, or they didn't properly calculate that fixed fair market value, or the stock market changes drastically and they just underestimated it. When we had a year ago with COVID, when it first started, the market just dumped, that changed the calculations on that 5% a little bit for some people. So all those things just need to be monitored. And again, it's just something that takes a little time, and you just got to get used to it when you start a private foundation.
Like making sure that you're reading the instruction manual, I guess, if you will, although there isn't an easy instruction manual there. Because again, speaking from experience, there's maybe some things there that you wouldn't necessarily think of unless you think to ask about them or get some advice on them on the front end.
Yeah, one area that you need to think about is how and where you invest. Another one of the excise taxes is jeopardizing investments. And typically, most private foundations we see invest in common stocks, your big stocks right on the stock market, and those don't usually have any problems. But you might want to go and invest in, say, a startup or something that's a little bit high risk or something like along those lines. And you would run into some problems there because the IRS doesn't want you to put your money into these risky businesses. They want you to give this money out to charity. So those kind of things you just don't even think about that can cause potential issues with the private foundation.
So you've mentioned 3 of the 5. Would you round out maybe the other 2 and maybe some examples there?
Sure. Another one that can be a problem is taxable expenditures.
Okay.
And that is where you spend money on something that's not charitable. The biggest problem we see, and it can be easily fixed usually, is, for instance, if you give to a non-public charity, say you give to a volunteer fire department that is organized as a C4, which is an association. It's tax exempt under a different section of the Internal Revenue Code. So technically, you can't give to that. But if that fire department is using it to help the community, you can go and ask them for letters, an expenditure responsibility statement, so that it proves to the IRS that, yes, you didn't use that money, but you gave it to this entity, this fire department, then they used it. Or you might see that with a Rotary Club where the foundation will give to the Rotary Club, which again might not fall under 501c3, but then they go and use that money to give scholarships to local students in the community. And again, a charitable purpose. So that is a really common area we see and we have to look into.
And just out of curiosity, I assume every time that there's a gift that's given like that, so say to the Rotary Club, that you're needing to get that letter and documenting that to make sure you don't have a problem there. Is that correct?
Yes, there's actually a little bit more process to it. You're really supposed to get a grant approval before giving it and have documentation up front so that, again, if you don't know the first time around, when you're filling out the return, you catch it and then you can, rectify it at that point and make sure you have the proper documentation going forward.
What's our 5th excise tax here?
Under distribution, we talked about excess holdings, jeopardizing investments, self-dealing, and taxable expenditures. We hit all 5.
We did hit all 5. Look at that.
Yes.
Yeah. I'll say don't call me an accountant for nothing, I guess, right? Yeah. So on the subject, any other things to maybe keep in mind when it comes to the kind of the care and feeding and watering of a private foundation?
I think it's just really asking questions and really thinking about, how is this furthering my tax exempt purpose? Is this really going to what I want it to go to further whatever my charitable giving needs are?
Talk about individuals, but also corporations and businesses have the foundations as well.
Yeah. For instance, a corporation might set it up and say they set it up for their employees who might live in hurricane districts. So then if they needed funding for a short period for housing or food, why they're disaster relief type of issues, they can set it up for that. We didn't mention, but a private foundation can give to individuals. Again, if the records are kept for indigent care, maybe coats to the community in the wintertime and things like that, or meals and things like that.
And actually, I know even speaking of BKD, I know that we have a foundation and we've done that in the past too in terms of situations that have come up. But yeah, dotting the I's and crossing the T's, as I guess as they say, to make sure that it's being done properly. We're a year going on now with the pandemic, and that has shifted. And obviously, there's been some trends as well as of late. But are there any other considerations from your perspective for those that are philanthropically minded, either to watch out for or opportunities maybe to be able to give?
There's so many different ways to give, but what you really need to do is look at your whole estate planning and see if there's other opportunities. We talked about private foundations, but there's also charitable deed trusts
Mm-hmm.
and charitable remainder trusts that are available directly with schools. You can do pooled income funds. There's so many different measures out there. There's some kind of giving and vehicle for you to give available if you are interested.
Do you find that sometimes that being the case, that it is sometimes a bit overwhelming to get the conversation started from those that are looking to do it? Or how do you suggest even going about that to try to learn more about the options that are available?
I would say that you really need to talk to your advisors. They know what they're talking about. They know the different type of charitable vehicles out there, and each one has their advantages and disadvantages. Again, some of it is the amount of time dedicated, some of it might be the amount of control. Those are the types of considerations. And again, your overall estate. It also might be if you need an income stream over the next several years, you could give to a charitable remainder trust where you're going to receive an annuity every year. And then at the end of that annuity period, the charity would receive their donation. It depends on your personal circumstances and your overall goals.
Important to know too, right? That there is no necessarily one size fits all. There are different options, and it is figuring out what fits your needs best. Something I guess I've heard of recently is extending financing to for-profit companies that are looking to drive change, or maybe trying to do different ways of going about maybe the mission that you're driven to. Are you seeing that or hearing that, and what are the considerations there, and what's that all about?
Yeah, the for-profits, I would say their biggest vehicle is direct, just going straight to the public giving, but a lot of them give a lot to private foundations. They'll give right to the public charities as well. And a lot of large wealth individuals are giving a lot more. I think we had talked before about Mackenzie Scott, who had her plan to give away her wealth within a certain time frame. She gave over $4 billion in 6 months. I think the biggest advantage to people like that and large companies is that they're doing a lot of research and planning on how to give out so much money so quickly that can really help some of our smaller foundations learn new ways to do the background checking, like we had talked, to make sure that they really are giving to a C3, and if not, have that paperwork. And I think that's going to help drive some innovation on new ways to think about giving, even at the smaller foundation levels. I've had a couple conversations with some larger foundations, and they said, we want to act like a startup. We want to have those newish initiatives and new thinking. And I think that's really great because private foundations have been pretty much the same for years and years. Tax law really hasn't changed much, but there's a new younger generation wants to do different things and find different ways to make it their own. And
Yeah.
I think with the for-profit initiatives and high wealth individuals working together, I think we'll find a lot more change even at the smaller foundations.
That is really exciting to kind of hear that. I don't know, any examples or things that maybe you can think of, again, thinking more like a startup and what innovation we might see as a result of that?
I know a lot of them want to just move faster, cut through the red tape, especially with COVID and all the factors, people losing their jobs and learning how to help, just learning how to build faster and build more efficiently. I said that a lot of our foundations are grant making, but there's another type. You can have an operating foundation where they actually have an activity. And that's where we see the most growth, really, where they're rethinking their childcare services or rethinking after school programs or housing for low income individuals or homeless. Those are really the areas that are changing in these operating foundations.
Changing the approach to maybe being a little less hands-on to a little bit more hands-on, it sounds like, in terms of the actual
Hmm.
underlying objective there and mission.
Right.
It's obviously a very big topic, and we've covered a few different areas here. Are the things that maybe you think should be in the conversation that perhaps we haven't mentioned so far?
I think we should talk a little bit about unrelated business income.
I think that's a really good point. Yeah. Maybe you could start with what is it and what are the implications there?
So, unrelated business income is income earned by a private foundation or public charity that is income that's regularly carried on, but it isn't something that's related to them. So they might actually be invested in some other business that they earn money from, which has nothing to do with whatever their charitable purpose is. So then the IRS comes in and says, hey, you have an undue advantage. If you aren't paying tax, then maybe a competitor. So they impose taxes on that unrelated business income. And depending on if your foundation was set up by a trust vehicle or under articles of incorporation, you might pay trust tax on that earning, or you could pay the corporate tax. And it all depends on how you were originally established.
So that's definitely something to plan for, because I would think that that can come as a surprise, certainly, to those that aren't maybe aware of that, I guess I'll say.
Again, it all goes back to understanding what your goals are, understanding the things you're investing in, and communicate and do your research and reach out to qualified professionals to guide you.
I would imagine in some cases, paying the tax there in those situations is an option, and perhaps sometimes the direction people decide to go to do that. Is it common, you think, that people are setting up with that and just saying, well, I know that's the consequence, so we're going to go ahead and do that? Or what's kind of the common thing you would see there?
I think the main reason is to get a higher rate of return on your investments.
Mm-hmm.
If you're just investing in the stock market or a savings account, you might not have as aggressive growth in some years as other vehicles. A lot of PTPs, which are publicly traded partnerships, they might invest in alternative investments, foreign securities. So those things are maybe a little bit more advantageous to get a cash flow, but the backside is you might have some tax.
I see. Okay, so it's balancing maybe the returns and the tax piece of it and at the end of the day, I guess.
Right.
No, I'm glad you brought that up, because I do think that's definitely a surprise that somebody doesn't want to have to be stuck with if they weren't planning on it, for sure.
That's very true.
Anything else along those lines that we didn't mention, or I think it's worth highlighting?
I think you really just have to know what your personal goals are,
Mm-hmm.
what you want to do, and talk to the experts so that you can make sure you're not running afoul of any of those excise taxes we talked about earlier, or getting a surprise tax bill on UBI at the end of the day.
Any thoughts on questions that you can ask? Because again, certainly there are options and there's an education piece, but I think there's maybe sometimes the fear of not knowing what you don't know. So any suggestions or recommendations on where to start in terms of asking questions?
Well, first, I would probably go out onto something like GuideStar. GuideStar is a charitable organization that collects all the 990 payoffs and 990s. And I would just search different private foundations. They're all open to public record, and just see who they're giving to, how they're structured. Read up about them. I think that's a really good place to start. If you want to be an operating foundation, just search on operating foundations, and you can see the different type of activities they might do. Or if you just want to give grants, do they give to local communities? Do they give to foreign entities? Just look and see how you might compare to some of those entities. And you'd also be able to see you don't have to start with $100 million. Some of them range from only $50,000 to $1 billion. So there's a range out there, and just see where you fall and where you want to be.
Seeing how it's done is a good way to learn, observe before jumping into the pool, perhaps. Well, this is great. This is very helpful, because I do feel like it's an area that, again, I hear a lot of interest in general with the pandemic and some of the need that it's created there, a desire to help and wanting to give. And I think that your insights and perspective are helpful to be able to guide those processes and thinking through what those options even are. So thank you.
It was really great. This was really fun. Thank you for having me.
I agree with Bernadette. That really was a fun conversation. Now, if you're looking for more in this area, please watch the archive of a presentation on charitable giving in the current philanthropic landscape, where Bernadette and I are joined by colleagues Jeff Lehman, Dan Prater, and Patricia Quintana Perrone to discuss the strategies donors and organizations should be considering right now amid a global pandemic and the current political environment. You'll find the link in the show notes of the episode, available at bkd.com/simplytax, along with links to articles from Bernadette with more on the topics that were discussed today. Please let us know how we're doing on Simply Tax by leaving us a rating and review on Apple Podcasts or wherever you get podcasts. Ratings and reviews go a long way in helping others find us. I'm Damien Martin, and thank you for listening.
The information contained in this episode of Simply Tax is based on data available as of the date of its release. BKD is under no obligation to update this information if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances. Any information provided is not to be considered as tax, legal, or financial advice. Please consult your tax advisor before acting on any matters covered.